Uh, Good morning, everyone. We're just getting started. Just give me a second, and should see the presentation momentarily. Um, can I, is it audible to everyone? Hope you're not having any audio issues or video issues. And will let me just start the broadcast. And the way we'll actually do it is I have a presentation which will take maybe about 20-25 minutes to go through, and I'll talk about multiple topics in that. As we go through, if you have any questions, you have a chat window in which you can actually send question to us. Our team at ArthaYantra will pick up the question, and once we are done with the presentation, uh, I'll start addressing those questions one by one. And at the end, you can also ask more questions. But I'm sure that as we go through the presentation, you will have questions which are really specific to what you're thinking. Don't wait to shoot the question on the chat, and I'll be able to address it once I'm done with the presentation. It's 11:04 right now, so let's wait for one more minute and then start off. So let's start off with the presentation at 8:05, and this is the agenda for today. So we are going through these topics over the next half an hour or so, 20 minutes or half an hour. We'll focus on the budget. There have been a lot of questions that we got on budget. There's a lot of anxiety among people, whether it's a good budget or a bad budget. That's something that we'll discuss about. Then we'll look at the global macroeconomic conditions. What's happening across the world in terms of macroeconomy, and also in terms of what we see as important commodities that drive the outlook of macroeconomy. Then we actually move on to the Indian economy and how we think Indian economy is doing. Finally, we'll end it with investment strategy, and then I'll give the top 5 takeouts for us from this session. One of the things that we also would like to know is that we plan to actually conduct this session on a monthly basis, and we would love your inputs on what can be better, how we can get you the information you need in a better way, in a more convenient way. And that's a feedback that we would all at ArthaYantra appreciate. That said, let's actually get into the presentation. So budget in 2016 was one of the most eagerly anticipated events from a financial events perspective. If you would ask investment managers or economists across the world, one of the top items that they really wanted to know was that will the government of India come up with a budget which will ensure that there's fiscal discipline. What is fiscal discipline? It's nothing but whatever the government earns, is it spending in the right way, and it's spending by looking at its income. It's very similar to what we do at ArthaYantra. Look at the income and expenditure and ensure that you're not spending more than what you're earning. And that's what a lot of economists expected from excuse me, from the Indian government. In addition to that, there were expectations of major reforms to come through. But how did the government do? I think the government had a very tough task of balancing between various aspects that it is facing today. And what it has come out with is a budget which really looks at ensuring that growth comes, primarily driving it through rural and semi-urban India rather than urban India, while at the same time not announcing any new populist measures, major populist measures, so that the fiscal deficit is managed. The fiscal deficit target that the government has come up with, which is in line with what most of us really expected. Also, in terms of the current account deficit, so what is the difference between fiscal deficit and current account deficit? Fiscal deficit is a deficit that actually can extend to multiple years, right? So you have payments which are due in multiple years. Current account deficit is whatever the payments have to be made in the same year, right? In short term, what are the short term deficit aspects that exist? So current account deficit also, the target, the expectation is that it will narrow to 0.7%. India is one of the few countries where we've been lucky that the oil prices have really come down, and that's really helped us here. But even then, I think it does take an effort to set the fiscal deficit target and achieve it. Just to give you a sense, past governments in India have not been able to achieve the targets that they've set. So if we can achieve the target of 3.5, that's something that we can really be proud of, and that can give impetus for growth. Having talked about this whole fiscal discipline, the other thing the government really looked at is also building assets, and there were a lot of elements, including increasing the road infrastructure, increasing other kinds of infrastructure, things like getting rural electrification completed, all villages to be to have electricity. These are major infrastructure and asset pushes of the government, which can yield a lot of results from a GDP perspective. And given this, and I would really look at this budget from a macroeconomic perspective as something where government is trying to keep a tight control on where to spend. From a revenue perspective and a tax perspective, one of the long-term I would say gripes to the middle class of India has been that the number of people who pay tax in India is very less. And it's mostly the middle class of India that has borne the burden of tax. This time, by coming up with taxation for professionals, where they could actually count to the minimum tax amount and pay the tax without any scrutiny, without any books to be shown to the income tax officials, is a major step towards expanding the tax base, and professionals, lawyers among you, CAs among you, doctors among you, now can just pay a minimum tax and ensure that all the earnings that you have are white in nature. That really removes a lot of headache of managing money and expands the tax base of India. Apart from that, one key element of tax which a lot of people are looking at is the whole EPF issue, where 60% of the EPF upon upon the age of 60, when the person withdraws the EPF, will be taxed. This includes the PF. So the government is following a EET, which is an exempt tax. So when it comes to tax savings, there are two types of tax savings. One is actual tax saving, where you get the complete exemption. The second one is tax deferral, where you don't have to pay tax on something that you are saving away now, but you paid at a later date. So tax deferral is also a kind of saving. So what the government is trying to do here is to really ensure that EET is followed for PF, and also it's telling customers, investors in India to look at NPS as a more viable option for long-term retirement. And this is the first clear indication that government wants most of the investors to move towards NPS. And we expect that 3 to 5 years from now, you will see a lot more NPS savings to happen in India than in EPF, and that removes a lot of burden on the government also, because once you move to NPS, you are reliant on the markets to give you returns. As perhaps the only advisor in India who offers NPS advice, NPS asset allocation, at ArthaYantra, we feel that NPS is a far more effective way of getting returns if you do good portfolio allocation, and it can really benefit a lot of our customers. So there is a huge push towards NPS. Apart from this, there is a push. Another important thing that we are seeing from a tax perspective is the first-time home buyers who buy a home which is less than 50 lakhs and take a loan which is less than 35 lakhs. They get an additional 50,000 deduction on the interest rates. Again, largely trying to help the middle class to buy homes for themselves. Purely from a personal finance perspective, ArthaYantra would, this is not enough for us to make a buy versus rent decision. I think buy versus rent decision is far more important. A lot of times we tend to look at the tax benefit and then make a financial decision. It should be the other way around. We take a financial decision and then look at the impact of it on tax. I think that's something that all of you have experienced through ArthaYantra already. And in addition, there's a very clear indication that automobiles, especially the luxury SUVs and luxury cars, upwards of 10 lakh rupees, there is going to be an additional cess that is levied on them. So you look at these taxes, increase in taxes, it's very clear that they want to shore up a bit more revenue. They are not opening up the purses and trying to push for populist policies. There's also a very interesting move, a very focused move to rationalize and ensure that the subsidies that are given, especially fertilizer subsidies and other subsidies that largely go to rural India, they are connected with Aadhaar to ensure that leakage of money is reduced. Today, a lot of the subsidy money actually leaks through the system. With this move, by connecting Aadhaar, we expect that money directly goes to the pocket of the farmer, thereby really ensuring the farmer benefits from whatever the government is doing. These are some very, very important. They don't look significant, but they have a very significant impact on the budgetary allocations of the country and can save a lot of money for the nations. And we are talking about in the tune of thousands of crores of savings. From a slab perspective, there has been no change in the slab. So there is a surcharge on people who are earning more than a crore. Also, this apply people who are in rented homes and don't have a HRA as part of their pay structure in their organizations. The limit that we provide to them has increased from 24,000 rupees per annum to 60,000 rupees per annum. It works out about 5,000 rupees of rent exempted from the pay. And if you look at the cube actually that we have here, so a lot of what I've covered, you can see there, rural sector, agricultural sector, more money in their hands, direct money for them. Even there, most of the people who exist in these sectors, want to get the money in their hand and be able to really, spend it in the way, that benefits them, and that's something that, this helps. Infrastructure investments will ensure that a lot of these villages and rural areas are connected to the rest of the country, including the productivity. So if you look at the whole, at a high level, these are the three. We think these are the three main blocks, which is asset creation, which is infrastructure, fiscal discipline, and rural development. All of these really are the cornerstones of this budget, and it's very interesting that when the day of the budget, the markets were really hammered and they were very volatile, and post budget, I think a lot of people realize the subtleness and the significance of these small looking announcements which have a big impact, and the markets have rallied. post-budget. At ArthaYantra, as you know, we don't believe in these daily movements. The volatility in the markets has been very high. That's always a concern for a advisor like us. But I think we are in interesting times with a lot of opportunity ahead of us. So with this, I would like to round up the budget thoughts that we at ArthaYantra have. And if you have any questions on the budget, please feel to drop it in the chat box, and our folks here will pick up the questions and will address those questions. Moving on, see, when it comes to markets, we are in a global, in a global market where there are a lot of interconnections. And while India itself, and even according to IMF, seems to be the only shining star in the global landscape, global macro landscape, we do get affected by what happens everywhere else. So if you look at the two most significant things that actually, from a macro perspective, country perspective, drive what happens here in India, and not just India, across global markets, is number one is the interest rate hike. Politicians and bureaucrats in the US have been pushing for inflation to rise in the US, and finally looks like it is rising. So that gives Janet Yellen and her team in the US to push the interest rates upwards. But pushing the interest rate upwards would make US a sinkhole in terms of all the dollars that are floating across the world at more riskier places will tend to go back to US, resulting in more demand for bonds and resulting in yields going up much faster in the US, which poses a problem for the US economy. I'm trying to keep the jargon as low as possible, but in case there's something that you don't understand, feel free to drop a note. I'll try to address it later during the discussion. So when the US dollar will strengthen primarily, and when the US dollar strengthens, it creates inflation in all the other countries, right? Primarily emerging markets. It could be Brazil, South Africa, India, China. China is perhaps the only country which has the wherewithal, and that's where China has a double-edged sword kind of a problem. They are seeing their economy slowing down rapidly. There is a real estate bubble which has burst already, and a great way to see how the problems that a country faces is to see how the government imposes restrictions on movement of currency. Over the last couple of months, what we have seen is that China has continuously increased the restrictions on how the renminbi, their currency, could be converted to dollars, and their fear is that there will be flight of capital. And at the same time, they want their currency to be, weak enough to push exports, but it cannot see a dramatic fall because China right now, though it's largely local debt, has a huge debt problem, and if the currency drops rapidly, it increases the debt problem. So I don't know if you can get a sense of what I'm trying to put here, but all these are interconnected, and they're very complex problems to solve, and they're not easy problems to solve, and that is going to have an impact on the global economy, and so the Indian economy. Driven by China's lack of growth, we are seeing the commodity markets, which got inflated over the last decade, cooling down. Oil has been the biggest loser here, and we are seeing oil at $37 a barrel, $37-40 range a barrel. It's very good for countries like India, but in countries like China, reduced oil does help them because they are the largest importer of oil. It also indicates that they are not producing enough. Their exports are not high enough. They wouldn't mind paying for a higher oil price if they have high exports, which is driving growth. This whole movement in China from being an export-driven economy to a consumer-driven economy is not going to be a smooth transition. It has never been a smooth transition. In fact, we have written very strongly about it, where we felt the countries which have tried to do it. You look at Japan in the 1980s, completely export-driven economy. They wanted to make it a consumption-driven economy. Last 20 years, the Japanese market really has not gone anywhere. It's in a deflationary ecosystem where the markets just don't move. And it could well be true that China would really fall into the same path. Let's see. I think only time will tell what happens in China. Similarly, what we are seeing, that the uncertainty of the economic nature that exists in the world today is one problem. There are also geopolitical tensions that exist, and this is a very dangerous combination. Right? Across the world, we are saying that GDP growth will be global GDP growth will be sub 2%. And you have geopolitical tensions. And this is a kind of time when you see hedging taking place, and gold becomes a very good hedge. And as a result, we have seen gold in the past month and a half surge more than 20%. And so you take all these into consideration, and the question is, how does it impact India? Right? And that's what we'll talk about. We talked about this global commodity prices, and we are looking at oil prices at $37 to $40 a barrel. We don't foresee this number going up in the near future because you have Iran also coming in and pumping out more oil. Both Saudi Arabia and Russia do not want to stop pumping oil, because once they do that, Iran could just capture the market they leave. So that's what they're worried about, and they just basically are holding on to the production levels. OPEC is really not cutting back on production. Similarly, precious metals like gold, which were at a very low, a 5-year low, have bounced back. We've seen silver and platinum also bounce back. And this is an indication that there is a lot of nervousness in the market about the state of the economy worldwide. And they feel that precious metals are a great way to hedge them. So in terms of the developed economies, US is seeing a good growth, 3.2% GDP growth, but their inflation numbers are higher, and that's something they've been seeking for a long time, because they were worried about deflationary pressures coming up. Now the question is, do they increase the interest rates and increase the cost of capital, making the dollar stronger? Japan has, with Abenomics, the whole idea was that the Prime Minister Abe will come out blazing and spend more and push the economy into the positive spin. That really has not worked out very well yet. The economy continues to be in stagnation. Japanese yen is continuing to, be, given out at interest rates which has been some of the lowest in the world. And they are going to, Japanese yen will actually continue to be used as a carry trade tool, which the dollar also has been used in the last few years. Eurozone again is muddled with multiple problems, right from the problem of immigration to the problem of Britain trying to leave the Eurozone. We still have the structural problems of Greece. They have not gone away, and that's something that we have to continue to watch. When you look at all these problems, right, emerging economies, we talked about BRICS, and India is the only country in BRICS which is growing and is expected to grow. Brazil is in negative territory, it's in recession officially. Russia is in recession, it's in negative territory. South Africa is in recession. China is slowing down, but India is expected to have a growth rate of 7.6%, and which will only increase. So India looks to be the only place in the world which will see growth in the next 1 year. So it's a great place to be. So given this current state of the economy, global and Indian, and the budget, what should be the investment strategy? At ArthaYantra, we have very strong views on what the investment strategy should be. The views are, that we should build really good diversified portfolios. Many of you who are investing through us over the last couple of months have seen our reallocation. Then you've been informed on the reallocation of portfolio. We have reduced our exposure to ASEAN countries and we've increased our exposure to India equity because India is a place to be. And we feel that we have really good portfolios, which a lot of people, and if you ask an investment professional, what is your ideal portfolio, the answer you get is, I want a low beta, high alpha portfolio. As we go out in the presentation, I'll explain to you what it means. But that's the strategy that we have been successfully implementing in ArthaYantra. So high sharp and well diversified portfolios. The number of portfolios that we have now has increased to more than 100. We run close to 15 million scenarios to really come up with it. So our whole investment strategy is to look at the macro and look at the asset allocation and build good diversified portfolios that can be tested. And a good asset allocation is about, if you want to see a good portfolio, good asset allocation, you should see how it performs in bad markets, not in good markets. In bull markets, almost anyone can give you returns, but good portfolios do extremely well in bad markets. The definition of extremely well is a bit different here. So they have far less volatility when compared to the regular portfolio. They lose far less money when compared to the regular portfolios or ordinary portfolios. And that's something that I think we at ArthaYantra are doing very well. So how does this work? So basically the way it works is that you have asset allocation, you have asset classes, and on average we do between 6 to 8 asset classes today. Our financial or econometric models throughout the asset allocation that should be there based on multiple signals, not just past performance. It includes macroeconomics, things like inflation, things like current account deficit. All of them are brought together, and the asset allocation is decided. And is this working? In the past, a lot of you have asked questions of ArthaYantra associates whether does it work, right? They feel when the market is bull, seems to be in in a bull run, it makes sense to do only equity. When the market is bear, it makes sense to just sell off everything. The key of investments that at least at ArthaYantra we feel is that you have to be in the game always, otherwise you can't score a goal, and you have to be in a game with the right kind of assets, and that can give you an edge, a huge edge, and that's what we've been seeing. If you look at the 7-year performance of our most common portfolio, which is a long-term moderate portfolio, what you see here is very interesting. Whenever the market grows up, our portfolios track the market. But when the markets fall down, and it's not once, it's multiple times, the gap between what we deliver and what the market delivers increases. So what does it mean? We are kind of creating a floor below which our portfolios don't go, right? So in the last 1 month, you can see the gap on the right side of the graph. When the markets have really fallen down, the gap between our performances, our portfolios, and the market has just widened, which means that our portfolios are doing much better than the market. Why is it happening? Because we are using science to create portfolios, and the science is working. Right? What is the proof? This is the proof. This is a very interesting study that we did. We picked up 2 of the competitors that our customers name most often, and their portfolios. They don't have 100 portfolios. They have very few portfolios. So we picked up whatever was the most common portfolio that they had. We picked up Nifty and our most common portfolio, long-term moderate portfolio. And if you look at it, this is 2015 February 23rd to 2015 16 February 23rd. And you could see the difference in the performance of the portfolio. This performance is far wider if you say, for example, month of Jan. This performance is far wider. But we feel that showing the differences in very small time periods is actually not the right way to really deliver information. So we've taken a 1-year lag. And if you look at the portfolio drops, it's quite stark, right? Our competitors have lost minus 12% and minus 11%, while we've lost just 4.3%. To give you a sense of it, a person who loses 10% in the market, to get back to par, so if he loses 100 rupees, 10% of 100 rupees, and goes to 90, to get from 90 to 100, he has to make 11%. Right? And how many portfolios in this market will give you consistently more than 11, 12, or 13%? Right. If you look at it from that perspective, these are numbers which are quite stark. Also, one key thing that, if you look at these numbers that comes out is from a psychology perspective, a behavioral finance perspective, is that when a market falls a lot and it's very volatile, we tend to make, as investors, we tend to take knee-jerk reactions and make a lot of mistakes. When the market actually, when the market actually is volatile and your portfolio is not volatile, we tend to actually take decisions in a much more rational way. And that's the beauty of behavioral finance that we've been seeing. We've had some customers, in fact, at ArthaYantra, we're very proud that a lot of customers are very comfortable with what we do and they understand the value system that is used to do what we do. What we did have some customers who came in and said, markets have fallen a lot, what should we do? And then they see their portfolio and say, oh, my portfolio has not fallen. And that's something we are extremely proud of, and that's something that you should be proud of. That in this kind of market, you are, as an investor, able to extract from the market a delta which is better than what others are doing. In fact, delta which is other than almost all others are doing. Right? So this was an interesting question. I remember that October, November, when gold was really not performing well, a lot of our customers were asking, why are we holding on to gold? Why should I hold 5% or 10% which the portfolio was recommending? And our whole answer was, you know what? As part of the diversification, it's important to hold this kind of an asset class, which becomes a very good hedge for any excess volatility that may exist in the market. And a lot of customers grudgingly were okay. They said, okay, we're fine for now. And it turned out to be the right call. In fact, gold has given an absolute return of 20% after that. But the way we really look at it is not about a right call or a wrong call. The call was not made because here in ArthaYantra, we don't make calls on one asset class, saying that this should be there or this should not be there. Our models throw out portfolio calls based on holistic data view. It's only data driven, it's not human biases driven. And our data told us that we should be in gold, and that's why we were in gold. We will not let our individual biases determine what kind of an asset allocation should be there, what kind of an exposure should be there to a particular asset class. And to me, that's a very important aspect. The discipline of hanging on to what you believe is a very important aspect of good asset allocation and long-term investing. That's something which we promote vociferously. So what we did next was to really look at some of the statistics, and these are very telling. We did the same thing. You looked at the results. So we also we did this numbers on the same competition using the same numbers for the same time period. And what we saw here was quite interesting. For people who are not familiar with some of these statistical measures, right at the extreme right you have beta. Beta is nothing but the systematic risk of the portfolio with respect to market. So in English, in plain English, if you have a beta of 1, your portfolio or your investments will move with the market at the same volatility. So market here is Nifty. So on the right side, you can see that Nifty is 1. So if your beta is 1, you will actually move with Nifty. So you are as volatile as Nifty. And not surprisingly, if you really look at, you've seen our performance, you look at ArthaYantra's beta, it's 0.56. What does it mean? It has about 44% less volatility than Nifty. Even the graph that you saw actually proved that. Well, our competition one of them had excess volatility, 1.20. One had almost the same volatility as Nifty at 0.97. And we should look at beta with something called as an alpha, which is next to it, right next to it. Alpha is an active return on investment. It's the excess return related to the market, right? And if you look at the alpha of ArthaYantra, we are at 2.50 more than the market. The market is par. and we are 2.50 more than the market. So you combine beta and alpha, for a lower volatility, we are giving excess return on the market. That's what it says today. While our competitors are giving excess of same volatility and lesser return. And this shows the quality of a good portfolio. This is one of the ways to look at a good portfolio. And you can take it to any investment manager anywhere in the world. They'll tell you the same thing. And it's very difficult to build these portfolios. Only the people with deep knowledge can build these portfolios. The next level of alpha and beta is Sharpe. Sharpe is nothing but, it tells you the return that you get per unit risk, the excess return that a portfolio gets for unit risk. Right? So Sharpe goes back and hits at the basic of investment, which is higher the risk, more return you should get. Right? So what Sharpe tells you is the excess return that you are getting, is it because you are taking more risk, or the same unit of risk is giving you more return? And again, there we are doing extremely well. Typically, a Sharpe of 1 greater than 1 is considered to be a good, very good portfolio. You could see that our competitors have a lesser Sharpe. But Sharpe has a statistical issue. It gives equal weightage to both negative, it's called kurtosis, and it gives equal weightages to upper movements of the market and downward movements of the market. So there's another measure called Sortino, which gives more weightage to the negative bias in the market. So Sortino gives you excess return in the market by giving more bias to the negative aspects of the market. And there also you can see that ArthaYantra's portfolios outperform everyone by a large margin. So combining all these things, what we are saying, and when I talked about this in the beginning of the session, low beta, high alpha is ideal. That's what we are doing. We are reducing the volatility in the portfolios by reducing the standard deviation, by creating a good diversification, removing as much unsystematic risk as possible. And as a result of that, our alpha is shooting up. And to me, that's a great place to be from a portfolio perspective. Right. The next aspect again is, something that we get asked a lot. A lot of our customers, feel that yes, you do asset allocation, but the funds that you are selecting, are they always right? Can they be wrong? Just a second, I'll just have a sip more. So choosing the right fund is one of the most important exercises we do after asset allocation. And there is more to it than it meets the eye. A lot of times, we get recommendations that, what, this is a 5-star fund in this category, why don't we just select it? Right? And I keep telling them that putting 5-star funds together will not create a great portfolio. It has never created a great portfolio. I've never seen a person who goes out and selects 5-star funds and makes a lot of money. This is because there is no science behind it. In fact, we do not look at the star ratings provided by third parties. And here I'm giving an example here to support what I'm saying. Most of you have large cap as part of your asset allocation. You are expected to get exposure to large cap, maybe 10, maybe 15, maybe 20%, depending on your risk profile. And how do you select a large cap fund for that? Right. Most of the times, and if you look at India equity markets, you have giant index. I'll call it giant or index cap. So the 50 stocks of Nifty, which are the largest companies in India. Then you have large caps, then you have mid caps, and then you have small caps. However, when you really look at a lot of large cap funds, while they are large cap funds, they tend to take a greater amount of exposure to these giant cap or index stocks. So the stocks which are outside of that, and here is an example of one such fund where you see a lot more exposure to the Nifty or a BSE stock base than to other companies. Only 22% are actually large cap. And here only 31.8% are only large cap. So when we do asset allocation, we say, okay, 20% you should have exposure to Nifty, which is the index, and 15% exposure to large cap. And if my funds are going to invest in same stocks, even my large cap invest in index, the effort that I put to really create a good risk versus reward asset allocation is gone. Right? This is just one important parameter that we look at. We look at 25 other parameters. So our effort, for example, in selecting a large cap fund is always to see that the middle bar, which is large cap bar, is as high as possible. Yes, in India, there is no true, completely large cap fund because the definition itself is murky a lot of times. But what that creates is a problem, which is inter-asset allocation overlap happens. And it really changes your risk versus reward. So one of the ways we really try to avoid it is by going to each of the fund and look at what they hold. We go into specific stocks and look at it. We look at the allocation that is done. And that's why a lot of times you will see that, you know, the fund we actually recommend might not always be a 5-star fund because it might not fit into our scheme of things, right? So imagine you are cooking something and you get all your ingredients, right? And you have to get the right ingredients of right quality and the right amount together to make a great dish. You cannot go out and say, I'll get 5 ingredients which are the best in class and put them together. You will not make a great dish out of it. You will make a great dish out of it only if they get together in the right amounts, right quantity, at the right time. And that's a science. And that's something that we take pride in, and we're very, very clear on why we do what we do, right? It has nothing to do with the star rating of one particular fund or the other. It has to do with everything, being together. So imagine I'm going to go to the analogy of cooking, and you have salt, and you put in excess salt because it's 5-star. It will not make the dish better; it will actually make it worse. So that's how it works, and our job is to really ensure that everything happens at the right time, at the right place. So coming to the fund selection criteria, these are some of the steps we take. We really go in and look at all the holdings that they have. It doesn't matter if it's fixed income or equity. A lot of times we have our own calls which are fed into our models. Here again, the models use mathematics to select the funds, and the human bias doesn't exist because human bias is can really change everything a lot of times. So we look at science for help here, and the results show that I think our calls have been good more often than not. So I would like to end this session by talking about some of the large important things that we have covered and what we see as a future. Apart from the transactional things, that what you can buy for less and what you can buy for more, the key thing the government has said for the economy, there are 2 primary drivers of economy from a structural perspective, institutional perspective. One is the government and its ministry. Second is the central bank, the RBI. What RBI has been asking from the government is show me fiscal discipline, and that's what the government has shown. Now the ball is in the court of RBI to come out and maybe perhaps reduce interest rates and try to push the growth up. That's a very important cycle that is happening. We are lucky that we have a progressive government and a progressive hawkish RBI governor who is very clear in his thoughts. We are in good hands from that perspective, and it will be very interesting how it plays out. We expect to see interest rate cuts. Will they be accelerated into the budget? I think that's a tough one to call. But we will see a steady interest rate cut to come in, thereby reducing the cost of capital for businesses, increasing growth in the country. And the impact of that would be seen on our markets. We expect the equity markets to be bullish. We expect the fixed income markets to do well. But one caution I would like to give for equity markets is that if you have a question, are we in a bull market right now? The answer is we don't know. If you look at the performance of the market over the last 6-8 months, they have been very volatile. They have moved upwards and downwards at rapid pace, depending on the news that has come in. So we still feel that that's something that's going to continue. But if you are in the hands of ArthaYantra and if you're following our recommendations sincerely, I think there is nothing to worry for you. That's what I would like to end this with. So there are some questions which I would like to go to. Before I get there, one recommendation or one feedback I would like from our customers is if they would like to see other areas also covered. We have covered a lot today, and we've covered a lot of technical stuff also. And if you think that there are some things which you think we'll be comfortable with if we cover, do send us a chat, reply on chat, or you can email us at care@arthayantra.com. We'll be happy to include those. Now, our whole idea is to really bring you our thought process, and hopefully today you got a sense of what we are thinking, and this should actually tell you how we think our investment strategy will change in the future also. So going to the questions, the first question from Ratin. First question is from Ratin. NPS as a retirement plan, is it good? NPS is similar to 401k in the US, and NPS primarily believes that your retirement money, you should put it in the market and make market returns. I would assume, being a pro market capital markets guy, that your markets will give you better returns than any fixed income that is subsidized by the government. What we will see is that the government will slowly but surely make it more difficult for people to be in PF, and NPS will become a de facto. And from that perspective, NPS is going to become more prominent. And from a retirement perspective, I think being in market and making money with the right kind of asset allocation is always good. And in fact, you here at ArthaYantra, we provide NPS asset allocation. We are the only company which provides that in this country, and we are very comfortable. We feel that that's a great place for our customers to be, for you to make more returns than you do right now with EPF. So, right, I hope I have answered your question. But if the small answer would be yes, it's good for you. The second question is from Ajit, and how statistical measures are calculated. So statistical measures are calculated using a set of standard formulae that look at the real data, real returns of portfolios vis-a-vis the market. The basis is a lot of simple things that we've all studied in our 10th class or in our 9th class mathematics. Things like standard deviation, variance, which form the basic underpinnings of a lot of statistical measures. And we use those mathematical models to really come up with the statistical measures. I hope I answered your question, Ajit. So 50,000 additional, next question is 50,000 additional benefit. When will it be applicable, Anil? 50,000 additional benefit, I'm assuming you're talking about the new house less than 50 lakh rupees. This is applicable after April 1st, 2016. The house you buy after April 1st, 2016. Looks like we don't have any other questions. I'll wait for a minute or two for more questions. If you have other questions, I'll be happy to address. Great. Please do give your feedback to us. If we'll sign off right now, but we would like to do this on a monthly basis. I also would like to take this opportunity to tell you that your company is growing. So we are now 60 people, and I think we wouldn't have reached here without you, our customers. And we are very proud of what we do, and we are based on your support is very important for us, and we hope to make you proud. Thank you. That's it. Do you have any other questions? That we have one suggestion that could we have a key do's and don'ts based on the budget? Yes, we would like. We'll create something like that, and we'll email it out. Thank you. Have a good day.
Sir, कितने लोग यार पता चलता है कितने ज्वाइन किए हुए? I think there were some questions from other sides. हाँ, 3-4 questions were there.
I don't know. यहाँ पे भी पता नहीं लग रहा है.
अच्छा. आप stop किया ना सर?
हाँ.
There were 2-3 guys at least from outside.
Hello. Hello. Yes. No, it's not right. आपने लोग सुना?
Sir.